If you're in your 20s or 30s and plan to have a comfortable retirement, as far off as it may seem, you may not have many options, but investing early is one of the best. To live a comfortable life, it's obvious that you'll need a substantial amount of wealth. And one of the most effective ways to do so, particularly for the working class, is to invest their money. You will become significantly wealthier if you begin investing early. Here is a wonderful example. Suppose you begin investing $500 per month and earn an annual return of 8%. If you begin investing at age 25 and continue until age 60, you will have $2.16 million at retirement. But if you begin investing at age 40 instead of 25, you will have only $341,000. Obviously, this simple example isn't anything new, and it's dependent on an investment earning 8% compounding annually, excluding inflation. But as I said, for the majority of people, this is still the best way to grow your wealth and ensure you have a nice reserve to spend during your lean years. In short, starting early increases the likelihood of success. We will examine some of the most important assets and investment decisions that young people can make. Now let's begin. Number 1. Index funds. Despite the high risk, stocks are one of the best investments you can make before turning 40. The returns are among the most lucrative. You have plenty of time to make and learn from mistakes as you begin your investment journey, but you should always make intelligent, calculated investments. The average rate of return on stocks is 10%, using the S&P 500 index as the benchmark. In reality, few investments will yield such a high rate of return. As you build your portfolio of index funds, consider bonding as well. Bonds may have the lowest rate of return, but they are the most secure, so you should include between 10 and 20% of bonds in your portfolio. This ensures the security of your investment. In addition, you could adjust the percentage based on your risk tolerance. Recently, crypto index funds were introduced despite not having been thoroughly tested. They appear quite promising. Current return rates range from 10 to 15%, which is quite high, but as return rates increase, so do the associated risks. Fees are a major advantage of index funds. The lower the fees, the greater the returns. Besides diversification, another benefit of index funds is that many of them have low fees. Investment expenses will rapidly reduce returns. Therefore, you'll want to avoid them as much as possible. And as you purchase index funds, you should also be mindful of the tax implications. Number 2. Real estate. Rarely will you make a mistake in real estate. Real estate is one of the best investments for a variety of reasons. First, there is almost always a housing shortage, and real estate assets almost always increase in value and appreciation. Purchasing your own residence is the first step in real estate investing. Residential property ownership reduces expenses such as rent. Once you own a home, you can consider constructing additional commercial properties. These may include multifamily residences, townhomes, offices, and other properties. However, if you are unable to invest in the real estate market directly, you have other options. There are numerous crowdfunding platforms that accept investments as low as $500. The invested funds would then be pooled with those of other investors and invested in real estate properties. Real estate investment trusts are these investments. Number 3. Education. According to statistics, your 20s are the optimal time to study. Research indicates that your 20s and early 30s are the easiest time to acquire new information. Therefore, now may be the best time to earn that additional degree. Education is essential because it can pave the way for professional success. However, you must recognize that not all education or learning is advantageous. Caution is advised, as some learning may be categorized as a hobby and therefore cannot be monetized. If you want to invest in education, look for careers that you have experience with and that can lead to success. This may also be the optimal time to increase your financial literacy. Number 4. Startup business. Invest in a startup while you are still young. While the returns on an enterprise are limitless, you will be able to earn as much as possible with an unrestricted ROI. A startup business is another investment you should make in your 20s. The potential for explosive ROI is phenomenal. Even if it isn't the next Amazon, investing in a young business can yield extraordinary returns. You are not required to start the business yourself. You can invest in the businesses of others in exchange for ownership stakes. For instance, you could be an angel investor, which is an excellent choice. If you know the founder, you can invest in the form of a convertible note, which can be converted into a loan if certain conditions are met. Alternatively, you can invest through crowdfunding. Before investing in a company, make sure you have a thorough understanding of the founder's background and the company's history. There are a number of crowdfunding platforms that feature promising startups. Choose businesses that have a compelling narrative and are led by founders with education, experience, or training in the business industry. By working with a venture capital fund, you can also become an accredited investor and subsequently a venture capitalist. However, these funds have minimum investment requirements and strict eligibility requirements. Number 5. Treasury bills. Treasury bills are essential investments for all investors, regardless of age. There is no better time to regularly purchase treasury bills than when you are young. Treasury bills are short-term debt instruments issued by the government to finance expenditures and regulate the money supply. There are 3 maturities for treasury bills: 90 days, 182 days, and 364 days. Everyone has expenses, including tuition, rent, and even professional exams. You can easily invest cash on hand in treasury bills and withdraw it when the bills mature. This falls under the finance concept of asset and liability matching, which involves the acquisition of an asset to finance the payment of an upcoming liability. Treasury bills carry no inherent risk. Therefore, your returns are assured, in contrast to other investment options. Additionally, the returns are respectable. Therefore, why not invest in them? Number 6. Growth stocks and dividend stocks. We have made it abundantly clear that one's 20s and 30s are a time to take risks. Because if you lose money at this point, there is still time to recover. Therefore, investing in stocks is an excellent way to invest a portion of your capital in a high-risk, high-reward venture. Simply put, growth stocks are those that are anticipated to grow at substantially higher rates than the industry average. These stocks generate more positive, sustainable cash flows and revenues than their competitors. Dividend stocks, on the other hand, are typically stocks of financially stable and mature companies, resulting in less volatile share prices than growth stocks. Include dividend stocks in your portfolio because, at a young age, they provide opportunities to earn a consistent income over a long period of time, assuming the companies continue to perform well. Number 7. Exchange-traded funds. Now, let's examine ETF, which are quite comparable to index funds. ETF, or baskets of securities containing multiple assets, such as stocks, bonds, and gold, are comparable to index funds. They trade similarly to stocks in that investors can purchase and sell shares on an exchange. Their versatility makes them valuable investment tools for investing in broad market indices, such as the S&P 500, sectors such as technology or health, and even subsectors such as social media or robotics. Schwab U.S. Large Cap ETF, Global X Robotics and Artificial Intelligence ETF, and iShares Global Clean Energy ETF are examples of exchange-traded funds. Number 8. Commodities. In economics, a commodity is an economic good, which is typically a resource with greater fungibility. That is, the market considers all or nearly all instances of a good to be equivalent, so regardless of who produced them, there are numerous investment opportunities. The initial step is to acquire varying quantities of physical raw materials, such as precious metal bullion. In addition to futures, contracts, and ETP, investors can invest through futures, contracts, and exchange-traded products that track a specific commodity index. Generally, only sophisticated investors are advised to invest in these highly volatile and complex securities. Mutual funds that invest in commodity-related companies are another method for gaining exposure to commodities. For instance, a fund specializing in oil and gas would own shares of companies engaged in energy exploration, refining, storage, and distribution. The benefits of commodity investing are portfolio diversification, potential return, and potential inflation protection. In addition, commodities have demonstrated the strongest performance during periods of inflation, making them one of the most valuable assets. Number 9. Annuities. An annuity is a contract between you and an insurance company in which the company promises to begin making periodic payments to you at some point in the future beginning immediately. You can purchase an annuity with either a single premium payment or a series of premium payments. Some annuity contracts allow for retirement savings. Others can convert your savings into a retirement income stream. Others perform both. You have a deferred annuity if you use an annuity as a savings vehicle and the insurance company delays your payout. In contrast, you have an immediate annuity if you use the annuity to create a source of retirement income and payments begin immediately. Variable and fixed annuities are the most common types of annuities. In addition, there is a hybrid known as an indexed annuity, also known as an equity indexed annuity or a fixed index annuity. Investors frequently consider annuities when planning for retirement. Therefore, it is advantageous to comprehend them. Additionally, they are frequently marketed as tax-deferred savings products. However, annuities incur numerous fees and costs. For example, surrender fees, mortality and expense risk fees, and administrative fees. Commissions on annuities can be as high as 7% or more. Number 10. Cryptocurrencies and initial coin offerings. Until recently, cryptocurrencies and ICO failed to pique the interest of traditional Wall Street investors. Investors are enticed, however, by the billions of dollars raised in ICO financings and the over 1,000 distinct cryptocurrencies currently in circulation. In addition, it is difficult for the majority of individual investors to comprehend these complex investment products and assess their risk levels. However, we do know that their returns are astoundingly high. The returns could range from 12% to 200%. Some ICO have performed exceptionally well. For instance, the OTA had a 13,000-fold return on investment. Therefore, if you had invested $1 when it was available, you would have earned $13,000. Well, there you have it. What are you waiting for? If you haven't liked our page yet, we have incredible content that will assist you in expanding and building your life. With that said, be sure to check out our other videos, and we'll see you in the next one.